Hello students, on this video clip we'll practice how to record the cost of goods sold on the income statement and then how to record the ending inventory on hand on the balance sheet throughout the period. Okay? As we discussed in the class, the same if a company purchased the same inventory, same goods several times at a different price, then how do you record the cost of that inventory when we sell some portion of this inventory, part of this inventory, the last purchased or the beginning purchased or the purchased in the middle? So we need to choose one of inventory cost method, like a specific unit cost or average cost, the first in first out or last in last out. For today, we'll practice average cost, which is based on the average purchase cost of inventory during the period. For example, small and large volume of products like coffee, water, beverage, one bottle of the beverage. We don't count each inventory cost when you sell the beverages. So we just calculate the average cost per one unit. Then we multiply the number of units we sold out of total inventory. Okay, so the average cost method, let's just assume that those are the cash transaction. As you can see that the January 1st, we already have had the beginning inventory, like 10 units, the t-shirts purchased at $10 per unit. So total cost of this inventory is $100. So this beginning inventory on December 31st, year one, is the starting point. The last year ending inventory is the beginning inventory of the current year, right? So this beginning inventory is the December 31st, year one, the inventory at the beginning. Then we purchased 25 more units at $14. So what is the total cost? Total cost is $350. And then September 1st, we purchased under the inflation there's 25 more units at $18. So $450 is the inventory cost. Then what is the number of units? What is the number of units, the inventory available for sales? You can just sum this all inventories on hand before selling. Then total cost is also the sum of this beginning inventory and purchase inventory, number 1 and 2, so 900. Okay, then finally we sold the inventory, 40 units at $25. Okay, then let's record first. This March 1st, we purchased inventory ignoring the accrual basis. Then inventory in how much on the debit side, right? 350. This 350. Then cash out 350. Then we purchased one more time the inventory 450, and then cash out 450. So we purchased those inventory. And then we sold the inventory 40 units at $25 per unit. So you remember how to record cash in. How much cash in? We sold 40 inventory, so $40 units times $25. So $1,000 should be the sales, right? The sales $1,000. At the same time, we need to record the cost of goods sold and inventory out because we sold the inventory. Inventory now is no longer on our hand, right? So how many inventory we sold? The 40 units. Then which the inventory we have to apply? 40 units. 40 units from this or this and this, or some part of this inventory, beginning inventory, or which one? So in this case, we don't know which inventory is sold. because customers doesn't care which cost of inventory they purchased. So we just need to calculate based on the average cost method this average cost per unit, $15, so that we can apply this $15 per unit times 40 units we sold. So the 600, and then we should record cost of goods sold 600. That is matching principle. Again, we sold the inventory 40 units at $25 per unit, but 40 units out of this, which this or this too, we don't know. So out of 60 total number of units, 40 units is calculated. Okay, average unit cost. So $900 total cost of inventory divided by total inventory available sales, so that we can calculate this average cost per unit. And then we apply this $15 per unit times $40, 40 units into the calculation of this, the inventory. And then that is the cost of goods sold that would be recorded on the income statement. Then paid tax, income tax paid. Okay, how do you calculate? Let me just put the name of account. Tax expense, the 40% of the profit, income before tax. So do you see the sales minus cost of goods sold is the profit, then times 40%. So the tax expense is 160, which is cash out the same amount. Okay. Then let's record this. Let's post this, the journal entry into the balance sheet. First, inventory up by 350, and then cash out 350. And then inventory again increased by 450, the additional inventory purchased. Then by this amount, cash out, right? The cash out. Then October 1st, now we made the sales $1,000, right? So sales increased by $1,000, and then cash in $1,000. Then inventory out, because we sold the inventory, so minus inventory 600. Then the cost of goods sold in the income statement, expense is negative, so 600. So our gross profit is now 400. Tax expense 160. Oh, before calculating this, we don't have any other expenses. So tax expense is 160. And then cash decreased by this tax expenses 160, right? So the net income is 400 minus 160 should be also retained in the retained earning. So we balanced out. So the cash total balance at the end of year 1, 940, and then ending inventory is 300. This ending inventory is 300. Now you can see that out of 900, we have 300, right? Out of 900, we have 300. Why? Because we sold out of 900, cost of goods sold to 600, the remaining is 300, okay? Now, next year, we made sales by selling the rest of the inventory, 20 units. Why? We sold 40 units out of 60, then the remaining is 20 units. So these 20 units sold at $25 per unit. So let's record also the sales. How much is the sales? 20 units times $25 per unit. So 500 is the sales. Now the cash in 500. Based on the matching principle, we need to record the cost of goods sold and then inventory out. Inventory on hand is 20, right? 20 inventory times how much is the inventory cost per unit, right? Still $15 per unit. So 300 should be cost of goods sold, 300. Then pay the tax, December 31st. Then this tax expense and the cash out, how to calculate it? Once again, the sales minus cost of goods sold times 40%. So $80. And then the cash like this. Okay. Now let's record this. Let's record this transaction, this journal entry into the balance sheet and income statement. This is one of the posting procedure, which is very important. Again, you have to keep in mind that all this, the balance sheet account should be accumulated next year, because the balance sheet shows the balance as of December 31st, year 2, from the start of the business till now. So the cash, we have to put this cash. The ending cash balance is the beginning cash balance of year 2. The ending balance of inventory of the last year is the beginning balance of the current year. So we have to start with this. Then retained earning also, we have to start at this point. Okay, again, the ending balance of the last year is the beginning balance of the current year. We should start from then on. Okay, then here, but you have to remember the income statement is not accumulation concept. The income statements for the year ended December 31st, year 1, year 2 means that just 1 year activity. We want to see the business activity every year. Okay, so it is not accumulated from the last year. Okay, because the income statement at the end of the day, this net earnings, net income is accumulated in the retained earning. That means that does not necessarily to the accumulated in the income statement. Okay, so the cash 500, now cash 500 in when we made the sales in the second year, and then the sales amount increased 500, and then the cost of goods sold 300 in the second year, so the gross profit is 200. We don't have inventory any longer because we sold everything, the rest of this inventory. So you don't record any inventory. And then the income before tax, we don't have any other transaction here. So the income before tax 200 out of 200. The tax expense is 40%, so expense $80 out. So the net income is $120 in the second year. Now we have to balance out how this retained earning should be added with this net income of the second year. So the retained earning accumulated is 360. So net income first year, the net income second year is 240, 120. The sum of these two net income is 360. Again, the balance sheet is the accumulation concept. Okay, so you see that the ending inventory. Now you don't have to just write here the ending inventory. Just the inventory at the end of year. At the end of year of this inventory is 0 because we sold this 900 inventory. So the cost of this inventory is 0. Now, do you see the cost of goods sold? Cost of goods sold this first year 600 from the inventory 900. Out of 900 we sold 600, and then rest amount of inventory sold out, that becomes this cost of goods sold of the second year. Okay, so all the sum of the cost of goods sold assuming that we sold every inventory, all the inventory, is that the same inventory 900 purchased cost. Okay, so in this case, we practiced how to record based on the average cost. You calculate the $15 per one unit and then multiply it by the number of units sold every sales. Okay, so see you in the next video clip. Bye bye.